Good afternoon. All right, you're a well-behaved crowd. For those of you who were not here first thing this morning, I'm Dave Altig. I'm the president of NABE this year. For those of you who were here this morning, I know the world is changing quickly, but I am still the same person I was when much to many people's chagrin, I'm sure. So, almost 2 years ago was our last, I think, in-person version of this event, and at the time we were talking about the election, tariffs, Brexit, and I didn't really kind of contemplate the fact that we might be viewing that as the good old days, but that really seems to be where we are. I just want to make a few preliminary comments and thanking some people. One, I want to thank the planning committee for the program and all the roundtable chairs who put together this very interesting and useful set of sessions that you are enjoying. Particularly the program chairs, Pia Renius, Mark Palin, Ellen Zettner. If you and all the members of the planning committee would stand to be acknowledged, please do so. I also want to acknowledge, and President Bostic sort of called this out this morning, all of the students who are joining us. And I have to say, I was in a session, one of the concurrent sessions, and the number of questions coming from the students was really gratifying. That's why you're invited here, and we have two very large student contingents from Villanova and Temple. If they and all the other students would stand. Thanks. And then, of course, on behalf of the entire NABE board, I do want to acknowledge and thank all of the conference partners who helped support us, the Peterson Foundation, AIG, KPMG, the McKinsey Global Institute, Morgan Stanley, the Census Bureau, Haver Analytics, Third Way, and Abbott, who provided the test kits so that we can all feel safe and sound as we collect together. So thank you all for your support. At this point, I'm going to call up LaVon Henry, who is the NABE Foundation chair, and he has a few words to say about the foundation. We all know it's more than a few. LaVon?
Well, my friends, first let me stop chewing. Thank you. My name is Dr. LaVon Henry, and I'm chair of the NABE Foundation. I'd like to say the NABE Foundation is now in its 18th year of supporting, as you just saw, the advancement of young professionals in the field of business economics. Over the past 7 years, from 2015 on, the foundation has awarded 643 scholarships and subsidies totaling $371,000, and we're continuing that effort. And in all transparency and honesty, we could not have done this without your support. We can't keep doing this without your continued support. You knew that was coming, right, my friends? One of the initiatives we've undertaken, and we'll talk more about it in a second, are NABE scholars, the conference scholarship winners, and the members of the NABE Foundation. Would you all please rise? Okay. NABE scholars, conference scholarship winners, and the NABE Foundation. As you look around the room, you'll notice the diversity, the increasing diversity of this organization. And that's because it's an intentional effort. Through our initiatives, like our NABE Scholars, like the Foundation has put forth, we're seeing an organization that looks more and more like America, and we are so blessed to have that outcome. I will say in all candor, despite the pandemic, we had a terrific year of fundraising in 2021, after a tough 2020. But we plan to have an even better one in 2022. With our expanded resources, we have expanded our offerings, and we're doing a lot right now. Let me run through the list, because I know standing between you and the Federal Reserve Board Chairman is not a great spot, okay? In 2021, excuse me, we awarded 67 CBE scholarships and subsidies, subsidized 52 meetings and conference scholarships for a total value of $67,000 plus. The Foundation will host our 19th Economic Measurement Seminar in 2022, back at the Four Seasons Hotel in Georgetown. And a special thank you we would like to extend to NABE members and leaders Maureen Haver, Jack Kleinhans, and Rich Wobekin for their many years of leadership at the EMS, which has been such a successful program. We will be funding the Frank Schott Scholarship, a longtime member of NABE, unfortunately no longer with us, that will send one young economist to a full set of CBE courses. And we ask each of you, send us some names. We want to send these young, brilliant minds to our courses so they can take over the leadership of this organization, okay? This old fart here, he can stay around forever. And finally, we want to talk about funding the NABE Scholars. The NABE Scholars is a program we began in November of 2020, and it's a group of 20 young economists from diverse backgrounds. And when we're saying diverse, we're saying all across this country. Everyone is getting a seat at the table. And we want to make it an initiative that really has teeth. This initiative, launched by two of our board members, Maureen Haver and Martin Fleming, is the Scholar Circle of Benefactors. We're working to raise money to supersize the program. No, McDonald's is not a sponsor, but to supersize the program and send these young economists and students to all NABE conferences and one CBE course, and provide additional travel monies to help make that a reality. If you want to join Maureen and Martin in the Circle of Benefactors, please contact myself or the NABE office. We're asking for $15,000 over 5 years to fund the program for 5 years. It can be done. It can definitely be done. And again, we need your help to continue our work. We have set this year actually a very modest goal to raise during this period of just $10,000, just $10,000. Why? Because generous donors have already agreed to match dollar for dollar, raising that, I was going to say raising that take, but raising that amount to $20,000. If you give at this meeting, you will receive a purple ribbon for the NABE badge. It looks just like this, okay? It's purple. We would love to see it rain purple badges. You see what I did there? Purple rain. So, how do you do this? Please use your donor cards at the table, if that's the easiest way, or donate through the NABE Connect app, a great app if you've never used it before, or online at nabe.com/donate. And let me say in closing, NABE really does care a lot about these initiatives. You support NABE by being here today, implying you care a lot about them too. We ask for you to dig deep, because we're going to make sure that through our deeply focused initiatives, we expand the knowledge base in the business economics community and across all our communities. Thank you very much. Have a nice day.
Thank you, Levon, and thank for your leadership as the chair of the foundation, and thank all of you in advance for your generous donations. All right, so let's get on to the main event, and we will call to this. Oh, Constance, you're there. Constance Hunter, Chief Head of Strategy and ESG at AIG. I got to get used to saying that. Come on board and introduce our keynote speaker, please.
Thank you, Dave.
Thank you, Dave. Thank you, Levon. I'm going to underscore the request to donate to the NABE Foundation. And it is my pleasure to introduce Jerome Powell, the chair of the Federal Reserve and good friend to NABE. Now, I probably don't need to read all of Chair Powell's bio. I think many in this room are familiar, but I would like to touch on a couple of highlights. Chair Powell first joined the Board of Governors in May 2012 to fill an open term, an unfilled term, and he was reappointed to the board and sworn in on June 14th, 2014. He then became Fed chair and is, of course, currently up for a second term. And so anyway, he's currently up for a second term. Now, Chair Powell has been in D.C. for a long time. He started his career here in D.C. He started his career at Carlisle. He served as Assistant Secretary and Undersecretary to the U.S. Department of the Treasury under President George H.W. Bush. And he has also worked on the Hill. And so he is a long-time feature of the DC scene. And really, we couldn't have, in my opinion, at this moment in time, anyone better as our Fed chair. So without further ado, I'm going to welcome Chair Powell to the stage.
Thank you, Constance, and thanks for the opportunity to speak here today. It's great to be back at NABE, and it's great to see so many familiar faces around the room. Let me first pause to recognize the many millions who are suffering the tragic consequences of Russia's invasion of Ukraine today. At the Federal Reserve, our monetary policy is guided by the dual mandate to promote maximum employment and stable prices. From that standpoint, the current picture is plain to see. The labor market is very strong, and inflation is much too high. My colleagues and I are acutely aware that inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials, like food, housing, and transportation. There is an obvious need to move expeditiously to return the stance of monetary policy to a more neutral level, and then to move to more restrictive levels, if that is what is required to restore price stability. We are committed to restoring price stability while preserving a strong labor market. At our meeting that concluded last week, we took several steps in pursuit of these goals. We raised our policy interest rate for the first time since the start of the pandemic, and said that we anticipate that ongoing rate increases will be appropriate to reach our objectives. We also said that we expect to begin reducing the size of our balance sheet at a coming meeting. In the press conference after the meeting, I noted that action could come as soon as our next meeting in May, though that is not a decision that we've made. These actions, along with the adjustments we have made since last fall, represent a substantial firming in the stance of policy with the intention of restoring price stability. In my comments today, I will first discuss the economic conditions that warrant these actions, and then address the path ahead for monetary policy. To begin with employment, in the last few years of the historically long expansion that ended with the arrival of the pandemic, we saw the remarkable benefits of an extended period of strong labor market conditions. We seek to foster another long expansion in order to realize those benefits again. The labor market has substantial momentum. Employment growth powered through the difficult Omicron wave, adding 1.75 million jobs over the past 3 months. The unemployment rate has fallen to 3.8%, near historical lows, and has reached this level much faster than anticipated by most forecasters. While disparities in employment remain, job growth has been widespread across racial, ethnic, and demographic groups. By many measures, the labor market is extremely tight, significantly tighter than the very strong job market just before the pandemic. There are far more job openings going unfilled today than before the pandemic, despite today's unemployment rate being higher. Indeed, there are a record 1.7 posted job openings for each person who is looking for work. Record numbers of people are quitting jobs each month, typically to take another job with higher pay. Nominal wages are rising at the fastest pace in decades, with the gains strongest for those at the lower end of the wage distribution and among production and non-supervisory workers. It's worth considering why the labor market is so tight, given that the unemployment rate is actually higher than it was before the pandemic. One explanation is that the natural rate of unemployment may be temporarily elevated, so that wage pressure is greater for any given level of unemployment. The sheer volume of hiring may have taxed the capacity of markets to bring jobs and workers together. The Delta and Omicron variants complicated hiring, and the strong financial position of households may have allowed some to be more selective in their job search. Over time, we might expect these factors to fade, reducing pressure in the job market. A second source of labor market tightness is that the labor force participation rate dropped sharply in the pandemic and has only partly recovered. As a result, the labor force remains below its pre-pandemic trend. Total demand for labor, measured by total employment plus posted job openings, has substantially recovered and far exceeds the size of the workforce. About half of the shortfall in labor force participation is attributable to retirements during the pandemic. History suggests that most of those retirees are unlikely to re-enter the workforce. But some non-participation is due to factors that may fade with time, such as caregiving needs and fear of contracting COVID-19. With prime-age participation still well below its pre-pandemic level, there is room for further progress. A more complete rebound, however, is likely to take some time. Increases in labor force participation often substantially lag declines in unemployment. Overall, the labor market is strong, but showing a clear imbalance of supply and demand. Our monetary policy tools cannot help with labor supply in the near term. But in a long expansion, the factors holding back supply will likely ease. In the meantime, we aim to use our tools to moderate demand growth, thereby facilitating continued sustainable increases in employment and wages. Turning to price stability, the inflation outlook had deteriorated significantly this year, even before Russia's invasion of Ukraine. The rise in inflation has been much greater and more persistent than forecasters generally expected, as this room will know. For example, at the time of our June 2021 meeting, every FOMC participant and all but one of 35 submissions in the survey of professional forecasters predicted that 2021 headline PCE inflation on a Q4 over Q4 basis would be below 4%. Inflation actually came in at 5.5%. For a time, moderate inflation forecasts looked plausible. The one-month headline and core inflation rates declined steadily from April through September. But inflation moved up sharply in the fall, and just since our December meeting, the median FOMC projection for year-end 2022 jumped from 2.6% to 4.3%. Why have the forecasts been so far off? In my view, an important part of the explanation is that forecasters widely underestimated the severity and persistence of supply-side frictions, which, when combined with strong demand, especially for durable goods, produced surprisingly high inflation. The pandemic and the associated shutdown and reopening of the economy caused a serious upheaval in many parts of the economy, snarling supply chains, constraining labor supply, and creating a major boom in demand for goods and a bust in services demand. The combination of the surge in goods demand with supply chain bottlenecks led to sharply rising goods prices. The most notable example here is motor vehicles. Prices soared across the vehicle sector as booming demand was met by a sharp decline in global production during the summer of 2021, owing to shortages of computer chips. Production remains below pre-pandemic levels, and an expected sharp decline in prices has been repeatedly postponed. Many forecasters, including FOMC participants, had been expecting inflation to cool in the second half of last year, as the economy started going back to normal after vaccines became widely available. Expectations were that supply-side damage would begin to heal. Schools would reopen, freeing parents to return to work, and labor supply would begin bouncing back. Kinks in supply chains would begin resolving, and consumption would start rotating back to services, all of which would help reduce price pressures. While schools are open, none of the other expectations has been fully met. Part of the reason may be that, contrary to expectations, COVID has not gone away with the arrival of vaccines. In fact, we're now headed once again into more COVID-related supply disruptions, this time from China. It continues to seem likely that hoped-for supply-side healing will come over time as the world ultimately settles into some new normal. But the timing and scope of that relief are highly uncertain. In the meantime, as we set policy, we will be looking to actual progress on these issues and not assuming significant near-term supply-side relief. As the magnitude and persistence of the increase in inflation became increasingly clear over the second half of last year, and as the job market recovery accelerated beyond expectations, the FOMC pivoted to progressively less accommodative monetary policy. In June, the median FOMC participant projected that the federal funds rate would remain at its effective lower bound through the end of 2022. And as the news came in, the projected policy paths shifted higher. The median projection that accompanied last week's 25 basis point rate increase shows the federal funds rate at 1.9% at the end of this year, and rising above its estimated longer-run normal value in 2023. The last FOMC statement also indicates that the committee expects to begin reducing the size of our balance sheet at a coming meeting. I believe that these policy actions, and those to come, will help bring inflation down near 2% over the next 3 years. As always, our policy projections are not a committee decision or a fixed plan. Instead, they're a summary of what FOMC participants see as the most likely case going forward. The events of the past 4 weeks remind us that, in tumultuous times, what seems the most likely scenario may change quite quickly. Each SEP, Summary of Economic Projections, reflects a point in time and can become outdated quickly at times like these, when events are developing rapidly. Thus, my main message today is, as the outlook evolves, we will adjust policy as needed in order to ensure a return to price stability with a strong job market. Let me turn now to 3 questions about the likely evolution of policy. First, how will fallout from the invasion of Ukraine affect the economy and monetary policy? Russia's invasion of Ukraine may have significant effects on the world economy and the U.S. economy. The magnitude and persistence of these effects remain highly uncertain and depend on events yet to come. Russia is one of the world's largest producers of commodities, and Ukraine is a key producer of several commodities as well, including wheat and neon, which is used in the production of computer chips. There is no recent experience with a significant market disruption across such a broad range of commodities. In addition to the direct effects from higher global oil and commodity prices, the invasion and related events are likely to restrain economic activity abroad and further disrupt supply chains, which would create spillovers to the U.S. economy. We might look to the historical experience with oil price shocks in the 1970s. Not a happy story. Fortunately, the United States is now much better situated to weather oil price shocks. We're now the world's largest producer of oil, and our economy is significantly less oil intensive than in the 1970s. Today, a rise in oil prices has mixed effects on the economy, lowering real household incomes and thus demand, but raising investment in drilling over time and benefiting oil-producing areas more generally. On net, oil shocks tend to weigh on output in the U.S. economy, but by far less than in the 1970s. Second question, how likely is it that monetary policy can lower inflation without causing a recession? Our goal is to restore price stability while fostering another long expansion and sustaining a strong labor market. In the FOMC participant projections I just described, the economy achieves a soft landing, with inflation coming down and unemployment holding steady. Growth slows as the very fast growth from the early stages of the reopening fades, the effects of fiscal support wane, and monetary policy accommodation is removed. Some have argued that history stacks the odds against achieving a soft landing and often point to the 1994 episode as the only successful soft landing in the post-war period. I believe that the historical record provides some grounds for optimism. Soft, or at least softish landings, have been relatively common in recent U.S. monetary history. In 3 episodes, 1965, 1984, and 1994, the Fed raised the federal funds rate significantly in response to perceived overheating without precipitating a recession. In other cases, recessions chronologically followed the conclusion of a tightening cycle, but the recessions were not apparently due to excessive tightening of monetary policy. To pick a recent example, the tightening from 2015 to 2019 was followed by the pandemic-induced recession. Now, I hasten to add that no one expects that bringing about a soft landing will be straightforward in the current context. Very little is straightforward in the current context. And monetary policy is often said to be a blunt instrument, not capable of surgical precision. My colleagues and I will do our very best to succeed in this challenging task. And it is worth noting that today, the economy is very strong and is well positioned to handle tighter monetary policy. Third, and finally, what will it take to restore price stability? The ultimate responsibility for price stability rests with the Federal Reserve. Price stability is essential if we're going to have another sustained period of strong labor market conditions. I believe that the policy approach that I've laid out is well suited to achieving this outcome. We will take the necessary steps to ensure a return to price stability. In particular, if we conclude that it is appropriate to move more aggressively by raising the federal funds rate by more than 25 basis points at a meeting or meetings, we will do so. And if we determine that we need to tighten beyond common measures of neutral and into a more restrictive stance, we'll do that as well. Our monetary policy framework emphasizes that having longer-term inflation expectations anchored at our longer-term objective of 2% helps us achieve both of our dual mandate objectives. While we cannot measure longer-term expectations directly, we monitor a variety of survey and market-based indicators. In the recent period, short-term inflation expectations have, of course, risen with inflation, but longer-run expectations remain well anchored in their historical ranges. The added near-term upward pressure from the invasion of Ukraine on inflation from energy, food, and other commodities comes at a time of already too high inflation. In normal times, when employment and inflation are close to our objectives, monetary policy would look through a brief burst of inflation associated with commodity price shocks. However, the risk is rising that an extended period of high inflation could push longer-term expectations uncomfortably higher, which underscores the need for the committee to move expeditiously, as I have described. To conclude, the past 2 years have been extraordinarily challenging for many Americans. 2 years ago, more than 20 million people were losing their jobs. Millions were falling ill, and lives were being disrupted and destroyed. We've made enormous strides since then. Today, as I've discussed, the labor market is very strong. But to end where I began, inflation is much too high. We have the necessary tools, and we will use them to restore price stability. Thank you.
Thank you, Chair Powell. I think if we were going to shortcut the headline to this, I think this is Powell's "the buck stops here" speech. So I'm going to dive right in. We're getting a number of questions. And so I guess I'll start with your comments about neutral policy and obviously getting to neutral first. So what does a neutral balance sheet look like?
Well, so we think of the equilibrium level of the balance sheet as driven by demand for our liabilities plus a buffer. That's the general idea. And liabilities are both currency and reserves and a number of other kinds of liabilities. These days, of course, we're in an ample reserves regime, which means that changes in the quantities of reserves will have no effect on interest rates that actually will be our administered rates that set policy. And so what that means effectively is an ample quantity of reserves plus a buffer plus the other liabilities. Now, as I've mentioned, pardon me, we're a long way from that today. We were fairly close to that level before the pandemic set in, before we bought quite a lot of assets. And I expect at a coming meeting that we'll begin the process of shrinking the balance sheet. And I said, broadly, that process should take around 3 years. We wouldn't get numerically back to the same level. We'll get roughly to the same level of GDP, I think. And of course, the details will be forthcoming as we get closer and closer to actually agreeing on those precise details.
So tangentially thinking then about the demand for dollars, and looking at what's happened to money supply, obviously necessarily increased rather significantly in the immediate aftermath of the pandemic, but now that increase has abated and it's increasing at a slower pace. How do you view this within the policy framework, and what do you do should velocity of money begin to rise?
So we generally think of inflation these days and for the last few decades as mostly about the balance between supply and demand. There was a time in U.S. history, of course, as this audience will know well, when money quantities were thought to be very important in determining output, determining inflation, and things like that. And it makes intuitive sense that would be the case. But, close to 40 years ago, the velocity of money, which is the ratio of output to the quantity of money, stopped having any trend. It was really, there was no steady relationship there, which is to say velocity was no longer constant. So we got away from that, and we look now to supply and demand. I mean, what seems to be causing the current inflation is things that happen, as I mentioned in my speech, that both that demand was strong, but also that it moved from services to a much more constrained goods sector. And then at the same time, the supply curve, if you will, for goods became essentially vertical in some goods. So, for example, when people wanted to buy a lot of cars, they're at home, they don't want to ride public transportation, they've got money on the balance sheet, they're not spending on trip, they want to buy cars. Ordinarily, the car manufacturers would say, this is great, let's make more cars. But you couldn't do that. Actually, car manufacturing declined because of the lack of semiconductors. So that's really what is behind the story here. I don't say there's no role for monetary quantities. And in fact, I would say over time, there probably is a relationship there, but I don't think it's an important part of the story at this time.
Thank you. So let's talk a little bit about something that you've underscored, that you underscored at the press conference on Wednesday, and you underscored in the speech today, which is the strength of the labor market. And I think a lot of us that are looking at the summary of economic projections and looking at the range of outcomes, doing our own forecasts, are concerned that we might see a higher unemployment rate before it falls to the 3.5% forecast. So one, do you see a direct path to 3.5%? And talk to us about how you see the evolution of labor markets in the face of getting to neutral.
Well, I guess where I would start is saying that having a strong labor market as I mentioned in my remarks, is an important thing, and it's been a big focus, frankly, of my time in this job. In fact, some of you may remember I told a congressional committee a few years ago when unemployment was 3.6% that I didn't see any heat in the labor market because wages weren't moving up. And so, this is something that I personally and my colleagues really want to get back to. The current labor market is though, as I mentioned, there's an imbalance between supply and demand. It is in so many respects much tighter, much hotter than the labor market we had before the crisis. So we have to take that into account in setting policy. There's excess demand. So in principle, less accommodative monetary policy could reduce excess demand for labor and stabilize the unemployment rate while labor force participation moves up, supply moves up, and those are the kinds of things that could reduce pressure in the labor market and help to make sure that wages are wage increases are on a path that is sustainable or consistent with 2% inflation. So that's our goal. As I mentioned, monetary policy is famously a blunt instrument. But we do place a high priority on a strong labor market. But ultimately, if you want a strong labor market, you have to have price stability. So we're very focused on restoring price stability and also fostering a strong labor market.
So, keeping on that thread, I think you aptly described the conditions that led to higher prices throughout the pandemic, right? We had a massive demand shock towards goods, growing at the first half of 2021 on an annualized basis of over 19%, compared to a normal rate of closer to 3%. And then, of course, we also had the supply constraints as a result of the pandemic. And so I would say that inflation seemed to be mostly demand pull, right? So even if we hadn't have had the pandemic, with that kind of surge in demand, we likely would have seen upward price pressures. But it seems to me the phase we're entering now is, as you mentioned, much more analogous to the 1970s when we had cost push inflation. And I wonder I want to get your thoughts on this, but one of the things I'm puzzling about is the extent of the elasticity of demand now that some of that fiscal stimulus has faded, that we are getting a little bit back to normal. And might we have a bit more price sensitivity in terms of the general public purchasing power than we did in 2021? Interesting.
So a few things to talk about there. So first of all, if you go back to a year ago, almost exactly a year ago, March of last year, when inflation arrived, it did not appear that this was the classic form of inflation where demand grows and grows and outstrips economic potential and the economy overheats and inflation moves up. Actually, the unemployment rate, I think, was 6% last March, something like that. And the labor force participation rate was a full percentage point below where it is now and 2% where it was before the pandemic. So there appeared to be slack in the labor market. But there is a role for demand. And it is, as you mentioned, it is that demand moved into goods and away from services. It's also that demand was really strong. There was a very strong fiscal reaction. There was a very strong monetary policy reaction. Demand was really strong. Nobody should deny that. But you could not drop that amount of demand into any of our models and produce this kind of inflation without supply side constraints. Mm-hmm. And so that inflation was really a product of strong demand, particularly in goods, meeting the constraints. So now, I guess what we're seeing now from Ukraine is really commodity related and supply chain related, and that is more like a classic supply shock, I suppose. And as I mentioned in my remarks, you would tend to want to look through that. I think we're going to be careful about that because inflation expectations are coexisting apparently with high inflation now, but we want to be very careful about moving expeditiously to get policy to where it needs to be. So I wouldn't say that we're comfortable at all with the typical sort of we'll just look through that approach.
So in that vein, then, what would prevent you from doing a 50 basis point move in May?
What would prevent us?
Yeah.
Nothing. Executive summary. No, as I've said, that's not a decision that we've made. It's not a decision that we've made. What I've said is that if we think it's appropriate to raise 50 basis points at a meeting or meetings, we will do so. And I don't have a test here, but for what will trigger that. But it just is this. We have an expectation. The expectation going into this year was that we would basically see inflation peaking in the first quarter, then maybe leveling out, and then see a lot of progress in the second half. That story has already fallen apart to the extent it continues to fall apart. My colleagues and I may well reach the conclusion that we'll need to move more quickly, and if so, we'll do so.
So there are a number of questions about real rates, neutral rates, yield curve shape. So I guess one of them is, should the Fed be looking at should we be looking at nominal Fed funds or the real Fed funds rate? And what do you expect the real Fed funds rate to be given our current dynamics?
So of course it is real rates that matter in the end, and we're very focused on that. In fact, if you look at where rates are, even real rates for many SEP submissions, they are actually above the estimates of the neutral rate. But not. I admit that the ones for the whole committee are not there yet. But again, I would see it as a work in progress. Ultimately, I guess I would add though that many things other than monetary policy, some things other than monetary policy, can work to reduce inflation. And I would point to a slowing in growth from the reopening of the economy, where we had very fast growth. I would point to the waning fiscal policy. I would point still to the possibility of supply side. We are beginning to see some, for example, in the vehicle sector, there is some evidence of progress on supply chains. So all of those things can help, and so it's not necessary for monetary policy to do 100% of the work. But as I mentioned in my remarks, we are not conducting policy now in the expectation that we will see significant near-term progress. We're going to be looking for actual progress at this point.
And that's an important distinction. So there are a number of questions about stagflation, which we all know is high unemployment and high inflation. That is, I think, not the situation we have now, even though people have bandied that word about. And I guess my question centers more around, we had come to believe that the bigger boogeyman was deflation or disinflation. And that, of course, was informed by nearly 40 years of inflation falling and interest rates, nominal rates falling. And were we maybe a little bit too quick to declare victory over inflation? And do you still think the prevailing wisdom, certainly in the halls of the Fed, is that disinflation, deflation is the bigger boogeyman, or is inflation the boogeyman that has come back and is the bigger boogeyman?
So, all right. So clearly, for the last quarter century, we've had a perfect storm of disinflationary forces, really. Demographics, globalization, technology, all came together to create disinflationary forces. Now, it's been argued that there's a number of books that argue that process is over and that we're going to go into a higher inflationary situation. I hadn't found that argument persuasive before the pandemic, and so the question is, we've now had, since that old regime, what's happened is we had a pandemic, we had very historically strong policy support from fiscal policy and monetary policy, and now we have a war that is generating untold, really uncertain economic constraints. And the question is, as we come out the other side of that, it's a really good question. The question is, what will be the nature of that economy? Are we going to go back to slower growth, low productivity, aging population, globalization to some extent still intact? or are we going to go back to a more segmented global economy where the effects of globalization on anyone's ability to raise the price of anything are diminished? And I guess it's really hard to say, but I don't think no one is sitting around at the Fed or anywhere else that I know of just waiting for the old regime to come back. I think people fully appreciate the situation that we're in. It's a series of shocks and events that have happened, and we have a job to do, and we're very focused on doing that job.
So speaking of shocks and events, in my new role as Global Head of Strategy and ESG, I'm thinking a lot about the impact of this transition to net zero and what it's likely to do to the price environment. Right, and so here I'm thinking of there are likely to be, I would expect, a number of shocks on our way to net zero in terms of lumpy policy implementation, uneven global policy implementation, of things like what happened in China with energy prices or what happened in Europe with natural gas. Concurrently, we are also likely to see a lot of, or a growing number of asymmetric idiosyncratic shocks in terms of climate events that put upward pressure on prices sporadically. And I'm just wondering, what is the way that monetary policy might respond to a growing persistence of shocks? And what is, how is the Fed thinking about the possibility of this occurring?
So I think in the short term, very short term, we're not really thinking of those as things that play into policy today. We, of course, are spending time thinking about how both physical risk and transition risk will play into the economy, into the financial system, into financial institutions, business models, and the safety and soundness of them, and all those sorts of things. So, but I guess I would say, though, that there should be a connection to relative price changes, right? So policy could favor different industries, different sectors, different regions over other ones. And by the way, those are not questions at all for the Fed, in my view. Those are questions for elected representatives, but that could happen. But those are really more relative price changes. Inflation is ultimately a monetary phenomenon, and it isn't clear to me at this point that there should be or would be inflationary effects as opposed to relative price changes, for example, between carbon-intensive activities and non-carbon-intensive activities.
Thank you. So I have a number of questions here that you're unlikely to answer, but just so that people feel represented, I'm going to lob a few at you. What probability do you put on the likelihood of the U.S. economy experiencing a recession as a result of the current economic challenges faced by the United States? And you went into a number of them, obviously the war in Ukraine.
So I don't see a reason to think that the likelihood of a recession, let's say in the next year, is elevated. And the main reason I don't see that is just that the economy is very, very strong. And I would point to growth, which is still by most forecasters reckoning at or above potential growth. I would also point to the labor market. If you look at the job creation we've had, it's been remarkable, and it has kept going. You mentioned boogieing. I would say that it did that right through the Omicron wave. So it's a strong economy, and I do think that. And I think it's an economy that can handle less accommodative monetary policy.
So we have a couple of questions here that throw cold water on jolts. I happen to know from our prep call that you are looking at more than just jolts. So if you could, the job openings, so things. Look at the St. Louis Fed labor market conditions index really suggests an unemployment rate closer to 3%. So if you could, I know you've talked about it extensively, but since there's still questions, just go into a little more detail on the tightness in the labor market that you're seeing and some of the indicators you're looking at.
Sure. So if you look at, anyone can pick a fight with any of these, but Basically, though, quits and job openings, quits in particular, and I think as well in some research, the ratio of job openings to job vacancies and wages, of course, they tell a story that is really different from the unemployment. The unemployment rate story at 3.8% it's the outlier in a way, because we had 3.5% unemployment for a long time with very low inflation. So I think the signals that are coming from that broader set of indicators all say that this is a labor market that is out of balance, that really has an excess of demand over supply. That chart that I showed shows that employment plus vacancies is like 5 million jobs higher than the labor force at this time. So that's why you're seeing widespread reports of job shortages. The surveys are in record territory of that nature, and of course wages are at 40-year highs. So all of those things, it seems to me, point to just a labor market that in a sense it's a great labor market. It's great for workers, but we need the labor market to be sustainably tight, meaning it has to be tight in a way that's consistent with 2% inflation over time. And there's good reason to think that this labor market would be at a more sustainable level if some of those indicators, if demand could be brought back in line with supply.
So I think many people in this room are familiar with the interesting work done by Jordan and Singh out of the San Francisco Fed early on in the pandemic, which looked at pandemics throughout history. And I would say at a high level, there's sort of two stylized findings. One is that wages tended to go up, in part because we lost labor in pandemics. And second of all, CapEx tended to fall after pandemics. And here in this, and obviously those previous pandemics, we did not have modern monetary policy, modern fiscal policy. We did not have the institutions that we currently have in their form that we have them. So we've seen a little bit of a different dynamic in terms of CapEx, a somewhat similar dynamic in terms of labor. And I guess my question is, how is the Fed factoring in the trajectory, the likely trajectory of capital expenditure and the likely trajectory of productivity? We had a bit of a productivity surge, and do you think it's possible that we could defy history in the aftermath of this pandemic with regard to CapEx and productivity?
I wouldn't say it's not possible. It's certainly possible. I think productivity in a world where little of what we work on is easily forecastable, little if anything, productivity is just not forecastable with confidence. So it just happens when it wants to happen. And of course, we all wish for more productivity, and it's great to see higher productivity. But forecasters, and we're no different, tend to assume that whatever level of productivity you're at will migrate back to the longer-term trend over time. And the longer-term trend is what, 1.5% or something like that. So that's what most forecasts are made of. You can certainly make a case if you want to that with the labor shortage there'll be a lot of investment, and the business will have to get done, and there will be investment in automation to replace human labor or to complement human labor. And all of that is a great story, and it may. I do think that will happen in the service industries, because ultimately the service industries, the public-facing service industries, will go back to their full output, but probably with fewer people. So you may well have productivity there, which would be great, and that would make these these high wage increases that we're seeing more sustainable.
So there are a couple of questions regarding long-term inflation target. And one questioner asks, would it make sense to shift the long-term target to 3% to assist with the soft landing and allow for higher nominal rates and a more normalized policy in the long run?
No, that's not something we're looking at. It's not. I think, no.
So there's a question here about financial conditions and credit spreads, which obviously we've already seen, as you mentioned in your remarks, a tightening of financial conditions. And how specifically is the Fed thinking about financial conditions going forward, especially considering some of the anomalies we're likely to experience as a result of the Ukraine war?
We look at a broad range of financial conditions, not any one thing. You know, it's rates, it's PE multiples, it's credit spreads, it's prices and risk spreads of all kinds. So we look at a broad range of financial conditions, and you know, there are countless financial conditions indexes. We look at all of them and try to make an assessment of of how tight financial conditions are, how loose conditions are. And you know, we've seen really since late last year, we've seen the market pricing in a number of rate increases. We've seen financial conditions tightening. We've seen, particularly in fixed income, you've seen longer sovereign rates move up in the United States very substantially, and across the yield curve. So, you know, and that's our policy. Obviously, works through financial conditions. We want to get back to a place that's away from the highly accommodative conditions that we put in place at the acute phase of the pandemic, and we want to do that expeditiously.
So we have a question here about, basically I'll call it the how much pain is the Fed willing to take question. So if the economy enters recession but inflation remains stubbornly high, are you willing to maintain tight policy and exacerbate or prolong a downturn to achieve price stability?
First of all, let me say that we don't think about the pain that the Fed is taking. We think about the public. And again, I'll just say we're very committed to restoring, really, price stability. And that is the thing that makes us able to pursue a strong labor market in the face of a strong downturn. You know, the world we've been in for 25 years was one where you could really go hard to support the economy when it weakened, because you knew that inflation expectations were anchored and you knew that inflation would stay under control. For the first time in a very long time, we have high inflation. And we know that we need to restore that. We really do. And so I don't see, in the medium term, I don't see a conflict between the two mandates. I think the best thing we can do to get back to where we want, which is a long period of sustained, strong labor market conditions, is to restore price stability.
Thank you. So let's see. I was hoping that might be my last question, because I think that underscores that this is the buck stops here speech. But some of these are great questions, but I know that they're either questions that were already asked or questions you're unlikely to be able to answer. So I'm going to go back, because there are a number of questions about it. I'm going to amalgamate a few together. So people are very focused on the possibility of 50 basis points at the May meeting, but people are also very focused on the shape of the yield curve and what it might be signaling. I have a feeling I know what your answer is going to be, but I'm going to ask this anyway. Is the Fed concerned at all about the yield curve actually inverting? And if it were to invert, would it impact the pace or magnitude of rate increases?
So we monitor, as I mentioned, a broad range of financial conditions. And the shape of the yield curve is just one thing. We do look at that. And we look at different measures. And frankly, there's good research by staff in the Federal Reserve System that really says to look at the short, you know, the first 18 months of the yield curve, right? And that has 100% of the explanatory power of the yield curve. And it makes sense because, you know, there's a reason why that would be the case. Because if it's inverted, that means the Fed's going to cut, which means the economy is weak. 2s to 10s, it's hard to know why that would. They started to have some economic theory of why that would be. Why that would make sense. We, of course, look at it. I mean, I won't tell you I don't look at it, but I do. I think, actually, I tend to look at the shorter part of the yield curve, though. And again, it's just one of the many things that we look at.
All right, well, we are at time. Thank you very, very much. This was fabulous.
Thank you. Thank you. Thanks.